Royalty and streaming companies provide upfront capital for project development or expansion in exchange for a percentage of the mine's revenue or production. This allows them to capture the benefits of commodity price increases and exploration success without the associated risks of mine operations. The core financial metrics for the sector as of January 2026, Franco, Nevada, market capitalization of $48.4 billion, trailing 12-month revenue of $1.53 billion, net margin of 60%, P/E ratio of 51, and a debt-to-equity ratio of 0. Wheaton Precious Metals, market capitalization of $64 billion, trailing 12-month revenue of $1.83 billion, adjusted net margin of 77%, P/E ratio of 64, and a debt-to-equity ratio of 0. Royal Gold, market capitalization of $23.44 billion, trailing 12-month revenue of $858 million, net margin of 56%, P/E ratio of 48, and an estimated debt-to-equity ratio of 0.32. OR Royalties, market capitalization of $8 billion, trailing 12-month revenue of $277 million, net margin of 60%, P/E ratio of 77, and a debt-to-equity ratio of 5.29.
Franco Nevada remains the largest and most diversified company in the sector by asset count, managing a portfolio of 430 assets covering approximately 70,500 square kilometers globally. Its strategy focuses on maintaining a clean balance sheet with zero debt, utilizing its strong free cash flow to fund new acquisitions, and a progressive dividend policy that has seen 18 consecutive years of increases. Franco Nevada distinguishes itself through its commodity mix. While gold remains the primary driver at 70% of revenue, the company maintains significant exposure to silver, 10%, platinum group metals, 2%, and an energy segment, 14%, consisting of oil, natural gas, and natural gas liquids. This energy exposure serves as an internal hedge. During periods where energy prices rise, the revenue from oil and gas royalties can offset the potential pressure on the gold-to-energy price ratio.
Geographically, Franco Nevada is concentrated in the Americas, with 86% of revenue sourced from South America, 38%, Central America and Mexico, 12%, Canada, 20%, and the U.S., 16%. This concentration in established mining jurisdictions is intended to lower jurisdictional risk, though recent events in Panama have tested this thesis. The single most influential factor in Franco Nevada's near-term valuation is the status of the Cobre Panama mine, owned by First Quantum Minerals. Previously a cornerstone asset for Franco Nevada, the mine was shut down following a 2023 Supreme Court ruling in Panama. As of January 2026, the situation has moved into a critical phase. International Chamber of Commerce, ICC, arbitration proceedings are scheduled for February 2026, and a definitive decision from the Panamanian government regarding the mine's future is expected by June 2026. Recent positive indicators include the government's approval of a plan to process 121,000 dry metric tons of copper concentrate currently stored at the site. Furthermore, the Panamanian president has authorized the removal and processing of low-grade ore stockpiles, which is expected to generate 700 direct jobs and royalty revenue for the state, signaling a potential softening of the anti-mining stance. The processing of these stockpiles could produce 70,000 tons of copper, which may offset preservation and maintenance costs for the remainder of 2026. The bull case. The bullish narrative for Franco Nevada is predicated on the re-rating of the stock following a positive resolution in Panama. Analysts at RBC Capital have upgraded Franco Nevada to outperform, citing the potential upside from Cobre Panama over 2026 as a major driver. If the mine returns to full production, it could add substantial gold-equivalent ounces to Franco Nevada's profile, which currently targets 420,000 to 440,000 GEOs for fiscal 2025. Beyond Panama, the bull case is supported by Franco Nevada's aggressive acquisition spree. In 2025, the company committed over $1.3 billion to new, high-quality, long-dated investments, including the Cascabel project in Ecuador and the Côte Gold mine in Canada. The Côte Gold royalty alone, acquired for $1.1 billion, is expected to supply approximately $67 million in annual revenue. The bear case. The bear case centers on the risk that the Panamanian government maintains its shutdown of Cobre Panama indefinitely, forcing Franco-Nevada to permanently impair the asset's value. While the stock has shown resilience, trading near a 52-week high, it carries a high PE ratio. If gold prices were to retreat from their current highs, Franco-Nevada's premium valuation leaves it vulnerable to a sharper correction than its lower multiple peers. Furthermore, the company faces insider selling signals, with over 15,000 shares sold by insiders in late 2025, which can sometimes indicate that management views the stock as fully valued.
Wheaton Precious Metals has surpassed its rivals to become the highest valued company in the sector by market capitalization, currently exceeding $64 billion. The business model is almost exclusively focused on streaming agreements. Wheaton achieved record-breaking results for the first 9 months of 2025, with revenue of $1.4 billion and operating cash flow of $1.2 billion. In the third quarter of 2025 alone, the company generated $476 million in revenue, a 137.5% increase in net earnings year-over-year. This growth was fueled by a 22% increase in attributable gold equivalent ounce (GEO) production, largely due to stronger output at the Salobo mine in Brazil and the Antamina mine in Peru, coupled with the commencement of production at the Blackwater mine. The company expects to produce between 600,000 and 670,000 GEOs in 2025, with production growing to 870,000 GEOs by 2029. Long-term, the company targets an average of 950,000 GEOs annually for the 2030-2034 period.
The most significant risk for Wheaton in 2026 is the evolving tax landscape. In 2018, the company reached a settlement with the Canada Revenue Agency (CRA) regarding the taxation of foreign income, which provided that earnings from its international streaming operations would not be subject to Canadian tax. While this settlement remains in effect, the Global Minimum Tax (GMT) initiative, OECD Pillar 2, has introduced a new 15% effective tax rate across jurisdictions. In the first quarter of 2025, Wheaton recorded a $45 million current tax expense associated with the GMT. The company estimates that tax payments under this framework will be due 15 months after year-end, creating a new cash outflow that was previously absent from its high-margin model. This tax is particularly impactful for Wheaton because its asset-light international subsidiaries, which hold many of its most lucrative streams, were the primary beneficiaries of the previous low-tax regime.
Wheaton is often viewed as the purest way to play the precious metals market due to its 99% revenue exposure to gold and silver. The bull case for Wheaton is centered on its organic growth profile. With 23 operating mines and 25 development projects, Wheaton has a visible path to nearly 1 million GEOs without the need for additional dilutive acquisitions. The recent completion of gold streams on the Hemlo mine and the Spring Valley project in Nevada, a $670 million commitment, ensures that the company will continue to add high-grade production in Tier 1 jurisdictions. Furthermore, Wheaton maintains a massive liquidity position with $1.2 billion in cash and an undrawn $2 billion revolving credit facility, providing the ability to secure new deals as miners seek capital for the next cycle of expansions. The primary bear case involves the structural reduction of Wheaton's earnings due to the GMT. If the company's effective tax rate rises from near 0 to 15%, it will lead to a permanent compression of its cash flow multiples. Additionally, Wheaton's revenue is more concentrated in a few massive assets compared to Franco-Nevada. If a Tier 1 asset like Salobo or Peñasquito faces localized operational issues, the impact on Wheaton's quarterly earnings would be disproportionately high. Finally, Wheaton trades at a significant premium even within an expensive sector, suggesting that much of the projected 2029 growth is already priced into the stock.
Royal Gold has transitioned into a larger, more diversified entity following its acquisition of Sandstorm Gold and Horizon Copper in late 2025. The company now manages a portfolio of approximately 400 properties across 31 countries, making it a high-margin, mid-capitalization leader in the sector. In the wake of its recent M&A activity, Royal Gold has prioritized the reduction of its indebtedness. Since closing the Sandstorm transaction on October 20, 2025, the company has reduced its borrowings by $400 million. As of January 12, 2026, Royal Gold's outstanding balance on its revolving credit facility was reduced to $825 million, leaving $575 million undrawn and available for future opportunities.
This rapid deleveraging is a testament to the company's strong operational cash flow, which reached $174 million in Q3 2025 alone.
Royal Gold's growth is anchored by high-quality assets like the Kansanshi mine in Zambia and the Khoemacau mine in Botswana. In August 2025, the company acquired a large, long-life gold stream on Kansanshi from First Quantum Minerals. The S3 expansion at the mine is ramping up faster than anticipated, with the first concentrate produced in August 2025 and an expected annual production of 150,000 ounces of gold from 2026 to 2042. At Khoemacau, the operator, MMG Limited, recently approved a $900 million expansion project designed to double annual production capacity to 130,000 tons of copper and 4 million ounces of silver by 2028. Royal Gold holds a 100% silver stream on this property, positioning it to benefit from significantly higher silver deliveries as the expansion comes online.
The bull case. The bullish thesis for Royal Gold is based on the significant increase in GEO deliveries from its newly acquired streams. The company's total stream segment sales for 2025 reached approximately 195,400 GEOs, and the integration of the Sandstorm portfolio is expected to provide further scale and diversification. Furthermore, as Royal Gold continues to pay down its debt, it is likely to see a multiple expansion as investors rewarded its return to a net cash position. The 2026 dividend is set at $1.90 per share, reflecting a 15% CAGR since 2000, making it a reliable income generator for long-term holders. The bear case. Despite its diversification, Royal Gold still faces concentration risk around a few major assets like Mount Milligan and Pueblo Viejo. At Pueblo Viejo, silver deliveries have been deferred as Barrick targets the completion of a silver recovery project in late 2025, which has temporarily impacted Royal Gold's revenue. Additionally, its exposure to Zambia, Kansanshi, and Botswana, Khoemacau, introduces higher jurisdictional risk than the Canada-focused Osisko or the U.S. heavy segments of Franco, Nevada. If gold prices soften, Royal Gold's debt load, while decreasing, remains a burden that its debt-free competitors do not share. Delivery delays at Kansanshi also posed a short-term drag, with 2025 deliveries of 7,500 ounces falling below the 12,500-ounce target due to initial contract mechanics.
OR Royalties focuses primarily on North American assets, with its cornerstone being a 3 to 5% NSR royalty on the Canadian Malartic Complex, Canada's largest gold mine. OR Royalties achieved record preliminary revenues of $277.4 million for fiscal 2025, earning 80,775 GEOs and meeting its annual guidance of 80,000 to 88,000 GEOs. The company's cash margin stands at an industry-leading 96.7%, reflecting a lean operational structure and high-quality royalty agreements. The company's growth profile is heavily supported by the Caribou Gold Project in British Columbia. A 2025 feasibility study for Caribou envisions an underground operation producing 190,000 ounces of gold annually over a 10-year life, with an after-tax NPV of $943 million. OR Royalties holds a 5% NSR royalty on the property, and first production could arrive as early as late 2027.
Osisko has distinguished itself by integrating AI and data-driven assessment into its prospecting workflows. This technology reportedly reduces legacy exploration timeframes from months to days and lowers costs by 80 to 85%, allowing the company to identify and secure royalties on promising junior projects before they reach the broader market. This AI-driven strategy focuses on traditional precious metals as well as critical minerals like lithium, cobalt, and rare earth elements. The bull case for Osisko is rooted in its best-in-class jurisdictional profile. With the majority of its assets in Canada and the United States, Osisko is insulated from the geopolitical instability seen in other regions. Its 5-year outlook projects GEO production rising to 110,000 to 125,000 by 2029, driven by the Windfall project and expansions at the Island Gold District. The company is also actively returning capital to shareholders, having repurchased $50.8 million of its shares in 2025 under its normal course issuer bid.
The bear case for Osisko is valuation-driven. The stock currently trades at a PE of 77. Some valuation models suggest the stock is overvalued by as much as 51% relative to its intrinsic DCF value. Furthermore, the company has a debt-to-equity ratio of 5.29, which is significantly higher than any of its peers and introduces a level of financial risk that could lead to volatility if gold prices were to decline. Insider selling has also been noted, with a key director cutting his stake by 15% in late 2025. Comparative financial and operational synthesis. To evaluate these companies for a balanced portfolio, it is necessary to contrast their efficiency and risk metrics side by side. Cash margin. OR leads the group with a 96.7% margin, followed by Royal Gold at approximately 84%, adjusted, Wheaton at 78%, and Franco Nevada at approximately 70%.
Revenue growth year over year. Franco Nevada showed the strongest growth at 77.3%, followed by Wheaton at 54.3%, OR at 45.1%, and Royal Gold at 20%. Dividend payout. Royal Gold offers the highest annual dividend at $1.90, followed by Franco Nevada at $1.52, Wheaton at 66 cents, and OR at an estimated 22 cents. Asset count. Franco Nevada maintains the most diverse portfolio with 430 assets. Royal Gold follows with approximately 400, OR with over 130, and Wheaton with 48. The comparison illustrates that while OR has the highest cash margin, it achieves this on a much smaller revenue base, whereas Wheaton Precious Metals and Franco Nevada represent the massive cash flow engines of the sector. Royal Gold occupies the middle ground, offering a solid dividend and the most active deleveraging story in the current cycle.
As we move through 2026, the jurisdictional mix of these portfolios has become a primary driver of investor sentiment. Franco Nevada and Wheaton Precious Metals have historically been more willing to engage in large-scale streams in South and Central America, while Royal Gold and OR have maintained a slightly more conservative focus on North American and Australian assets. The green metal transition has also influenced portfolio construction. OR and Wheaton have both increased their exposure to battery minerals like copper, nickel, and cobalt. OR's expansion into these minerals, providing a hedge against the possibility that precious metals underperform industrial metals during an expansion in global infrastructure investments. The gold royalty sector is projected to outperform traditional mining stocks throughout 2026 due to the relative stability of the royalty model and built-in diversification. Forecasts suggest average annual returns for top-tier royalty stocks will range between 7% and 12%, supported by persistent inflation risks, geopolitical tensions, and central banks increasing their gold reserves.
However, the momentum versus value score deterioration indicates that the sector may be due for a period of consolidation. If gold prices stabilize near $4,700, the focus will shift from price-driven revenue growth to project execution and the ability of operators to bring new mines online on schedule. Conclusion. The comparative investment analysis of the 2026 royalty and streaming sector reveals a mature industry, capitalizing on historic metal prices while navigating structural tax and jurisdictional changes. Franco Nevada remains the most robust choice for investors seeking broad diversification and a fortress balance sheet. Its energy hedge and the impending resolution of the Cobre Panama situation provide a unique mix of stability and catalyst-driven upside.
Wheaton is the premier choice for those seeking the highest margin leverage and a transparent, organic growth profile. While the global minimum tax is a clear headwind, the company's ability to grow production by 40% through 2034 makes Wheaton a leader in long-term volume growth. Royal Gold serves as the value alternative, appealing to investors who favor financial discipline and aggressive debt reduction. As it pays down its sandstorm-related debt, it is well-positioned for a valuation re-rating. OR Royalties is the growth at any price selection. For investors willing to overlook high leverage and stretched multiples, OR offers the best exposure to high-grade Canadian assets. In the final assessment, the royalty and streaming sector continues to offer a risk-adjusted way to participate in the precious metals bull market. By decoupling the upside of $4,700 gold from the inflationary risks of mining operations, these companies provide a resilient and scalable investment narrative for 2026 and beyond.